Hey there, everyone. We have a huge week coming up this week. Probably the biggest catalyst that we have coming that the market's holding its breath for is the conclusion of the Fed meeting on Wednesday when we get the interest rate decision, which is expected to remain exactly where it's at for the federal funds rate. But even bigger than that is the summary of economic projections and the commentary that's going to come along with it. Ready to hear from the Fed what they have to say about inflation, and the big thing that's really been rattling the market recently would be GDP, and I'm sure that the question is going to come out about tariffs as well. By the way, I do put write-ups about these things and a lot of my technicals over at the Discord, where you can find me and others like me putting out content all the time, putting out our trades. Tons of trade wins coming in every day. I can scroll through the list and show those to you. Guys can find the link for that Discord down in the description. 57% win right there, 22%, 67%, 53%, and they just keep on coming in day after day after day. So you guys can check that out too by using the link down in the description for the Discord. You'll find the bread bot over there. There's also other AI features that are over there, advanced charting, and like I said, community, thousands of members, and then we have tons of the panel experts, StockMo over there as well, where you can go, you can find us, you can see what we're trading, you see what we're talking about, what we're interested in, and then you guys can also learn from that. And if you're interested in improving that amount of learning that you have and you want to learn about technical analysis, how to trade it, and then also options, there's also coursework down in there. Code word cash for the Discord is going to save 50% off the first month. And then also down in the description, you'll find the code word doctor for the coursework. That's going to save you a ton of cash as well, where you can learn to trade like we do, where you'll find it over in the Discord. Guys, let's jump right into the content now. So when we look at the economic calendar, there we go. For Monday, we got retail sales. This is actually kind of huge today because it starts to talk about GDP. And, well, we know that GDP has really been where the mess has been recently. And so that's going to be huge for us to see. Also, New York Empire Manufacturing. So we only have a few more reports left that are actually going to impact what we see for GDP. And so the Atlanta Fed GDP, now we'll talk about that a little bit as I get to the summary of economic projections. But the Atlanta Fed does put out a calendar, and you can see we have today, happy St. Patty's Day, by the way, tomorrow with the industrial, there you go, housing starts, production, capital capacity utilization, imports and export prices. My goodness, it is the morning, isn't it? And then the 26th and 28th, where we get advanced census manufacturing, and then personal income and outlays, which includes the PCE, the personal consumption expenditures, that we're also want to look at as well. So we only have 4 more reports to affect that GDP. Big day starting today into tomorrow. And then when we get to Wednesday, there it is, 2 p.m., we get the Fed interest rate decision and the summary of economic projections that comes out with it as well. And then all the way down here, the Fed press conference at 2:30, where Jerome Powell himself comes out and speaks. Well, let's take a look at the summary. This one's from December. And you can see the adjustments from 2024 to 2025. So GDP being pulled back a little bit. Not necessarily great to see the slowdown, still positive though. And then you can also see from September to December that the unemployment rate went from 4.4 down to 4.2, but the Fed expected it, at least in terms of the median estimate, to be up at 4.3, where before it was 4.4 for 2025. So the labor market a little bit tighter than they thought, and even pulled back a little bit to 4.3. Now, that's actually pretty important to pay attention to as well. I'll show you the chart as well as on unemployment. PCE inflation, you can see they actually moved up from September to December. So we'll see where the Fed puts that. And, we've gotten, at least for this month, speaking of last month, we've gotten some decent reports on that. And we'll see what sort of commentary we get. And then finally, the federal funds rate that happens down here. You can see that 3.4% that the Fed expected much more cutting in September than they did to December. So let's talk about GDP first. So that change in real GDP, what we're looking for is, are we going to move significantly off this 2.1% expectation? Is that something that the Fed's going to signal that that's going to come in a lot weaker? As a matter of fact, if we move over it, we have central tendency numbers 1.8 to 2.2. So we could also watch for that shift. Remember, the median is a middle number out of that. So we could see much more extremes coming into that, and we want to watch for that. And then if you just go all the way to the end of this, you find the range for GDP 1.6 to 2.5, whereas before it was 1.3 to 2.5. So you can see that the bottom part of the expectation shifted. So looking all the way across that, we could get a better feel for what exactly the Fed's looking at as a whole, and see the median number, I think, is going to have that biggest impact for what we watch. But we do want to look at all of it holistically here to see what it is that we're facing, at least according to the Fed because they're going to actually have a fair amount of influence. If they suspect a lot of weakness coming our way, that can drag the markets down, especially if they say anything that points at recession. I think they're going to be reluctant to say such things, but we'll see. So if we go over to the Atlanta Fed GDP now, you can see the thing that rattled the markets most recently and really did put a lot of drag onto the markets. Now, in terms of debt to GDP ratio, we already know that the debt is getting close to unmanageable levels. And then when you start to shrink the GDP, you make it harder to service that debt, and then it increases the risk of default in the United States. And it can even mean a credit downgrade prior, like without missing that. Now, mind you, a default on US debt would be catastrophic. So we absolutely don't want to see that happen. That would be very bad for probably a very long time. So we want to be prepared for whatever comes our way. I don't think that it's that bad, but we'll watch and see what happens. I don't think that a default is something that's coming our way, but we do want to see things that allow that GDP to be pushed back up. So there is some pressure on the Fed. So based on what the Fed sees, we'll see for GDP. I don't think the Fed wants necessarily a big, deep, dark recession to happen. They did say that they wanted a little bit more weakness to bring down inflation and ensure stable prices. So we'll see which side they're leaning towards. Are they leaning more towards now what we have for inflation, or more towards unemployment? Is GDP something that they're really going to weigh in on? So unemployment rate, by the way, I have this zoomed in for you, and let me zoom back out. So here's going from, oh man, this goes back a really long time here, 1948 to present. And you can see in the gray areas that come along here how much unemployment rate starts to spike up. And you can see more recently right here that we actually had that upturn, and the market started to get worried that this was going to take off, and then we would have rampant unemployment. That would be part of that signal that recession is what we're seeing. And then just towards this very tail end over here, let me make sure we're over as far as we're going to get on this one, and we're not. Let me go back out here. We'll go to the 5-year. There we go. So just on this tail end of things, this is what we're looking at right now. So 4.2 is where we peaked out before. If we did make it up to the 4.3 by the end of 2025, like the Summary of Economic Projections from December said for the Fed, that means that we're back up above these previous peaks. So this is that kind of ramping up that you saw of the unemployment rate, and then it started to just tail off just a little bit at the very end. So the market actually very positively received this sort of non-rampant unemployment rate, if you will. So I don't think that would be the first signal that we would have. We do want to be careful about what exactly we see from that, especially where the SOM rule is concerned, because last time that was really janky for the markets. It might happen again. So in terms of unemployment rate, if the Fed signals this number higher, this 4.3, if they say by the end of 2025 that they see it more going to 4.4, 4.5, it's going to be a lot of downward pressure on the markets. So GDP, we want them to keep that number near where it's at right now. It'd be really nice to see that go up. I don't know how they make a case for GDP going up at this point in time, but if they do, the market's going to be like, hey, the Fed says that this is a fluke. It's not so bad, at least according to the Summary of Economic Projections. Unemployment rate, hopefully staying at 4.3%, and then we'll see as we go across in terms of 26, 27 in the longer run, how they see that going as well. So if the Fed signals this thing going up significantly from where they have it right now at 4.3, if they start talking about 4.5, 4.6, they might sound like small changes. Those are enormous changes, and that could actually show us an increase in the unemployment rate from where we're at right now. The Fed might not like that. So when we go over to PCE, the personal consumption expenditures, there we go. We zoom in on that, you can see going across this, and right now I have it set to the rate, that negative 0.2%. That is what it rounded to recently. We definitely don't want that to go negative, but just stabilization going straight across, if you will. As a matter of fact, we'll take the pandemic out of it. There we go. So you can see a little bit more that we started to lose some of the volatility, that we started to move around this 0.5%, if you will. A little bit of jankiness is there. Being up around 2% is actually a little bit more of what we're looking at. We don't want that recessionary-led deflation. That would be the worry. That would be too low for that, too high for that. We did start to have those peaks moving upward, watching those peaks climb and climb, especially going from September. October was the low, November up more, and then December even up more after that. So the Fed, I think, is going to be really careful about how they talk about inflation. Last time they said that a lot of the inflationary pressure that they were seeing, some of the tail end of things starting to come in, that those lagging indicators were something that were starting to subside, but it was something that they were watchful for, and something that's keeping up those interest rates for right now when they talk about higher for longer, and that gets into the federal funds rate. look what they had for end of 2025. They had a 3.4, and then they subtracted. They absolutely deleted the expectation for 2 more rate cuts, 25 basis point rate cuts to come off of that federal funds rate. So that's what we're looking at right now in terms of that. And then core PCE went from 2.2 to 2, from 25 to 26 up to 2.5, and then 2.2 after that. So for as per the CME FedWatch tool, where does it have us right now for December 2025? So the end of the year, that's actually right now between 3.5 and 4. So that would average out to 3.75. So it would actually put us in the middle of what the summary of economic projections says for the end of December. So now, mind you, that's a number that changes all the time, and it has shifted significantly since the Atlanta Fed GDP Now estimate came out, and it's just showing right now that we could potentially be seeing a negative quarter coming in, and we have 4 reports coming in. Now, mind you, that's something that's not even the advanced estimate. The advanced estimate doesn't come out until April the 30th for GDP, but we get the final numbers on that by the end of March here. I think March 28th was that final date that we looked at when we looked at the GDP Now calendar for this one. By the way, just go to Atlanta Fed GDP and then just search Atlanta Fed GDP Now. When you get to the Atlanta Fed, hit release dates, and that's where you can see those dates come in. So the CME FedWatch tool, the peak for this used to be between 3.75 and 4.25. And so that's the one that you have right here. And you can see that peak is now shared. And that goes back to a month ago. Now that peak is shifted down just a little bit. So instead of being between these two, it's now between these two middle that you see peaked up at the moment. And then if we go back to May, because for March right now, there's not a lot to see. There's almost zero expectation for a cut to be in March. Now, we can actually talk a little bit about that cut coming in. So let me pop myself back up here, because we'll talk about, well, what happens if the Fed does cut? If the Fed cuts now when nobody really expects it, even if Jerome Powell was like, well, we just thought it was time, that could signal that the Fed got behind again, and now they're like scrambling to hurry up and make cuts. So we want to be watchful. I don't think that the Fed makes the cut this time. I wouldn't be surprised if Jerome Powell sets the foundation, lays the groundwork for that cut to happen during that next time. And if he does, and we are really going to pay attention to the tone that he comes out with and the way that he's answering questions. And if he comes out like super hawk again, the market's probably not going to like that. But if he also comes out as super dovish, that's unexpected as well, then the market starts to go, like, why are you, they're gonna suss him out if I talk like my teenagers do. They're going to be like, well, why are you so soft on this now when you were so hard on this before? And so that's something that's going to be pretty darn big to listen to, is the tone that he comes out with and how the market perceives it, and watch the initial reaction that we get as the market starts to digest what exactly Jerome Powell has to say during that question and answer time and the remarks that he makes. So comes off too dovish, well, it can be like, well, you guys are behind again. Now you're just trying to do whatever you can and scramble in order to salvage things. So being too dovish could signal recession. Being too hawkish could put further downward pressure onto the markets. So the question is, will Jerome Powell find that sweet spot right in the middle? Is he actually going to field any questions on tariffs? Is he going to, which he probably won't, honestly, until more of them are in place. But hopefully he gives us some sort of color as to what exactly they expect for inflation. Do they still see it subsiding? Do they see it inflecting back upward on us? And honestly, like the inflation side of things, if they see inflation going back up, that can be further disruption to the bond market, because that just eats up the value of the bonds when you have that high inflation, which pushes up the bond yields, and that makes the debt more unserviceable, and that makes things even harder, especially if they see GDP come in more subdued. So it's a very nuanced answer, and I'm going to piece this together over time for you guys, and just so keep on coming back here to YouTube, or if you want to see more of my commentary in detail, written out, spelled out, charted out, you name it, you guys can find that over at the Discord. Remember to use code word CASH when you sign up and join the thousands of members that are over there already in the best community that I've ever found. Our Discord, it's ready to go for you. It's waiting for you. Use that code word CASH when you sign up. And if you guys, like I said, want to learn about technical analysis trading, how to trade with options, there's coursework there as well. That link is also down in the description. Make sure to use code word doctor for that one to save that cash. Guys, thank you for watching. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. We'll see you next video.